Hello and welcome to this transfer pricing webinar, part of the 2020 International Group of Webinars. My name is Ros Martin. As always, if you ask questions, I may pick them up as we go along, or we will deal with them at the end of the hour. Okay, so let's start off by having a look at an introduction. So transfer pricing is looking at situations where profits are being diverted from one entity to another. So the structure of transactions is such that there is manipulation of profit between different entities. Now, the assumption built into transfer pricing is that this is being done to save tax. And so opportunities will normally exist where there is a connection between companies. Now, in the UK, the main provisions of the transfer pricing legislation is found in legislation called TOPA 2010. As we will see as we go through, there is a lot of common links between the UK transfer pricing legislation and that which is applicable in other jurisdictions. So let's just have a look at a very brief example of what the issue might be with transfer pricing. So we have a situation where a UK company sells goods to an American subsidiary company for £100. Those goods were purchased by the UK company for £80, and therefore they make £20 profit by selling to the US. Now, that item has a retail price to third parties of £150. So if they'd actually sold it to a third party, they would have made £70 profit rather than 20. Now, in this scenario, the American company makes the £50 profit. The overall profit to the group remains the same. Now, when we're talking about a UK and a US subsidiary, it's probably the case that those transactions may not be motivated by any desire to avoid tax. But if that subsidiary was actually somewhere where the tax rate was very low, or indeed there was no tax payable on corporate transactions, then overall the group might well end up saving significant amounts of profit by doing these kind of transactions. Okay, so because transfer pricing is often about cross-border transactions, though it is quite important to remember, certainly within the UK, transfer pricing can also apply on UK to UK transactions. But because we are often looking at cross-border transactions, the agenda for transfer pricing is essentially set by the OECD, so the Office for Economic Cooperation and Development, or the Organisation, sorry, for Economic Cooperation and Development, and they have issued very extensive guidance about the way transfer pricing should be applied. And we will be talking later on about the BEPS project, the Base Erosion and Profit Shifting project. One of the areas that has looked at has been transfer pricing. The UK legislation is very closely based on the OECD model, as indeed is much of the legislation in other jurisdictions as well. So in the UK, what the legislation does is it effectively imposes an arm's length price where there are effective transactions. There are some exemptions which we will look at, and there is a provision within the legislation for what is called compensating adjustments, so that both parties would make adjustments. And there are also provisions within the UK legislation for payments to be made between parties so that the transactions become neutral. And again, we will look at those as we go through. So let's have a little bit more of a detailed look at the rules within the UK for transfer pricing. So it talks about where associated enterprises are parties to transactions which are on terms other than arm's length, and the transaction has the potential to give rise to a UK tax advantage for one of the parties, then the legislation determines that the tax for profits and losses of that party are to be calculated as if the transaction had been made on an arm's length basis. So on the face of it, we are saying that if you're an associated enterprise, you undertake a transaction where there is potential for a UK tax advantage, we recalculate the value. The specific provision or the specific conditions which apply are that the provision that we are looking at has got to be by means of a transaction or series of transactions. You have got to meet what is called the participation condition, which is effectively determining the link between the parties involved in the deal. So there has to be a connection. The definition, as we will see in a moment, is quite a wide definition, but there has to be some kind of connection between the parties. The third one is that the actual provision differs from that which would be established on an arm's length basis between independent enterprises, and the actual provision confers a potential advantage. And that would then bring into play the transfer pricing provisions unless an exemption applies. Now, we will look at a couple of these conditions in a little bit more detail, but transaction or series of transactions is relatively straightforward. Almost anything that is done is going to be done by means of a transaction or series of transactions. The one important point to note about that phrase, though, is that it could involve third parties. So you could have a series of transactions between connected parties, but where there was a third party involved, and that would also potentially be caught. So it does look at quite complex structures, and there can be circumstances where perhaps you wouldn't imagine that transfer pricing might be at point, but it is going to be an issue. Arm's length provision is the provision which will be made between independent enterprises, and not surprisingly, this is the most difficult aspect of the transfer pricing rules, because it's about establishing what that arm's length provision would be, and we are going to look at that in some detail because there are various methodologies that can be adopted when we are looking at the actual arm's length provision. When is there a potential advantage? Well, there is going to be a potential advantage either where you reduce your profits, where you increase your losses, or indeed you turn a profit into a loss. Fairly logical. I don't think there is necessarily much complexity or even much controversy about when there would be a potential tax advantage. Okay, so let's have a look at the participation provision. This is the underlying connection between the parties which would establish that transfer pricing needs to be considered. The legislation states that you are the participation provision condition is met where one of the affected persons was directly or indirectly participating in the management, control, or capital of the other, or the same person was directly or indirectly participating in the management, control, or capital of each of the affected persons. So you've either got one person controlling the other, or you have got them effectively both being controlled by someone else. Direct participation is again further defined. There will be direct participation in the management, control, or capital of a company if A is a corporate body and A is controlled by P, so that's the participator. And in this context, control means power, the power of the participator to secure that the affairs of the company are conducted in accordance with their wishes. And that might be by means of holding shares or voting rights, either in the actual company or in another corporate body, or as a result of any powers conferred by the Articles of Association or any other document regulating a or any other corporate body. So it's either going to be by virtue of holding shares or voting rights, but there is this overall caveat or this overriding caveat, which basically says that if there is some article formal document which confers control by P, then that would be sufficient to enable somebody to argue that control is being exercised. Indirect participation is divided into four possibles. So this is where P has the potential to be a direct participant in the management, control, or capital of A. So this might be a situation where P has the right to acquire shares in the future, or indeed where they have control over shares held by someone else. So there might be some kind of trust arrangement where they don't directly control the shares, but they have effective control of shares in a company. I think the one that probably does catch people out more is this idea of getting shares in the future. They have the potential to acquire shares in the future. The second one where we see quite a lot of business structures caught is where P is a major participant in A. Major participant basically means that somebody has more than 40% of the shares in a company. There is somebody else who has more than 40% of the shares in the company without either of them controlling it. So typically joint venture kind of arrangements can end up with people being major participants. And we'll look at a couple of examples in a moment of the more common type structures that we see. There are then situations where we have participants acting with other persons to provide financing arrangements to A, and there is a definition of financing arrangements within the legislation, and then there's another one where P is acting with others to provide financing arrangements, and basically they would have control if the rights and powers of that other person were attributed to P. So there are circumstances involving financing arrangements where we can get indirect participation. It's actually quite rare to find transfer pricing issues in those kind of circumstances. We'll look at financing arrangements in themselves a little bit later on. So if we just have a look at a couple of examples, clearly in this situation we have a very straightforward scenario where A is under the controls both B Limited and C Limited, and very straightforwardly, and I'm sure most people would understand how this works. In that situation, then they are all going to be associated enterprises for the purposes of transfer pricing. If we had a more linear structure where A, B and C are in a vertical line, where you have got control exercised in that way, again, A, B and C Limited would all be caught. They would all be associated enterprises for the purposes of the transfer pricing provisions. And again, I don't think that comes as any surprise or will come as any surprise in relation to transfer pricing. This is an example of the major participation type structure where you have E Limited who has, where B Limited has 45% of the shares, C Limited has 40% of the shares, and then we have D Limited with 15% of the shares. Now, B and C are both major participators in E because they have at least 40% of the shares, but nobody has overall control. By virtue of being the 100% shareholder in B, A is also brought into the mix, which basically means that A, B, C and E Limited are all associated enterprises for the purposes of the transfer pricing provisions, and any of the transactions between those parties could be scrutinised to make sure that they are on an arm's length basis. D Limited, owning only 15% of the shares, is in no way connected, is not a major participant, and would not be brought into the mix in terms of transfer pricing. Obviously, much more complex group structures would need to be examined to make sure that the conditions were not breached. And as I say, the kind of transactions that we see, the kind of structures that are caught are fairly common across all of the major jurisdictions. Okay, so let's have a look at some of the exemptions from the transfer pricing provisions. Companies which are designated as small or medium-sized companies within the UK are not automatically caught by the transfer pricing provisions. I'll come back to that in a moment because the definition, there are some exceptions to that exemption. Dormant companies are also not caught by transfer pricing. There's a slightly strange definition of dormant companies because a company only falls within the definition of a dormant company if it was actually dormant in 2004 and continues to be dormant. So slightly strangely, any companies that have come into existence since 2004 and are dormant wouldn't actually fall within the definition of a dormant company. Of course, that's a slight red herring because dormant companies are unlikely to have any transactions where there are any transfer pricing implications, but you do just need to be a little bit careful about that. There is an exemption from the transfer pricing rules in relation to exchange gains or losses on what are described as loan relationships within the UK, which are basically transactions for the lending of money, or indeed where you have derivative contracts. The reason that they are effectively exempt under the transfer pricing provisions is because they have their own intrinsic transfer pricing provisions within those bits of legislation. And in fact, the bottom two on that slide, and that is in relation to the calculation of capital allowances within the UK, which is the mechanism by which businesses get relief for their capital expenditure, or indeed in relation to the calculation of chargeable gains or losses on the disposal of capital assets. Again, both of those bits of legislation have their own intrinsic transfer pricing provisions, so are not caught by the general transfer pricing provisions in the UK. The middle one on this slide is where you have transactions which are otherwise than between enterprises. So if you have a transaction between two businesses, effectively they are caught by transfer pricing. But if you have a transaction with somebody who is not in business, then that would not be caught. So the example that is given, though probably this example would only apply in relation to small or medium-sized companies anyway, but if you had an individual lending money to a company, if that individual is not an enterprise, is not organising their lending on a sort of an arm's length basis, then you wouldn't have to impose transfer pricing between those parties. Let's just focus on the SME situation. SMEs, as we've seen, don't normally fall within the transfer pricing provisions, but they can elect for the exemption not to apply. And they are also caught where the affected person, that's the person that they are transacting with, is resident in a non-qualifying territory. A non-qualifying territory is defined as being a territory where the UK does not have a double tax treaty with a non-discrimination clause in it. So basically where non-residents are treated differently from residents, and a lot of tax havens will fall within that definition of being a non-qualifying territory, though obviously you would have to consider the double tax treaty if there is one. Where an entity is medium-sized, HMRC can actually issue a transfer pricing notice, but that would affect the company going forward only. The definition of what constitutes a small and medium-sized enterprise is the definition enshrined in the European law. I'm not going to go into that in any detail, but you can find that information. So compensating adjustments, the basic provisions within the legislation don't actually require an adjustment is made to the person who is disadvantaged. So the disadvantaged person is the person who effectively is paying tax, not unnecessarily, but where somebody else is also paying tax on the same amount. However, it is often specifically provided for in double tax treaties within jurisdictions. And in fact, for UK to UK transactions, there is a specific provision allowing for a compensating adjustment to apply. Obviously, if you're talking about compensating adjustments where you have cross-border transactions, it will often be the case that both the transfer pricing adjustment and the compensating adjustment have effectively got to be negotiated with both of the tax authorities, because obviously if, say, you have a UK as one leg of the transaction and they say, yeah, we're going to increase the profit in the UK, obviously there is going to be a disadvantage in the other jurisdiction, because that tax authority, if they agree a compensating adjustment, will collect less tax. So obviously it is something where often there are quite complex negotiations where one jurisdiction is potentially looking for more tax in relation to a transfer pricing transaction. It's also possible, and we did touch on this before, it is possible for payments to be made between the parties on a tax neutral basis. So if one party actually makes a payment to compensate the other for a change in the tax status, or indeed for the disadvantaged person to pay the advantaged person's tax, that is tax neutral. So there's no tax charge arising on transactions of that nature. Okay, where we're talking about compensation or compensating adjustments, adjustments can be made regardless of the normal time limit. So within the UK, for example, there are time limits where you can't amend historical returns. But if we're looking at compensating adjustments, those normal time limits don't apply. And there may need to be adjustments to things like double tax relief if we have got compensating adjustments. And also within the UK, there are various pieces of anti-avoidance legislation. So, for example, you can't make a compensating adjustment if the disadvantaged person is not a company. And that is a specific anti-avoidance provision that was introduced a couple of years ago because HMRC considered that there was abuse of the provisions where partnerships were involved. And it was a very specific scenario, but you just need to be a little bit careful in that particular scenario. We've already mentioned balancing payments can be made without there being a tax charge. We sometimes see balancing payments having to be made where there are third-party investors. So if we go all the way back to this original example, in this scenario, if there was a transaction that was recategorized within E, for example, then D Limited might come along and say, actually, the value of E Limited has gone down because of this adjustment. I'm disadvantaged as kind of an innocent participant in E Limited, and therefore I want balancing payments to be made from either A, B, or C in order to effectively compensate E Limited for the transactional differences that have been computed. So that's the kind of situation where you might get a payment being made between the parties, and as I say, that would actually be tax neutral. Okay, so let's move on now and think about the most tricky part of transfer pricing. There is no right or wrong way to calculate an arm's length price. There are very extensive guidelines published by the OECD to assist tax jurisdictions in this process. They are constantly updated and reviewed, and they were updated very extensively in 2016. So we are looking at quite current guidelines which exist. There are various basic principles which apply when we are looking at transfer pricing and about getting this arm's length price. It's all about making sure that the transactions that you are trying to compare with or what you are trying to achieve is in some way comparable. So if we go through the basic principles that are shown on that slide, we start off with comparability. If we are looking at an arm's length price, if we are making a comparison between a controlled transaction and a comparable transaction between independent parties, you do need to make sure that the two transactions are comparable. And you do that by identifying various commercial and economic circumstances, taking account of the industry, whether there are any anomalies, and whether there are any factors which might affect the performance of a business operating within that industry. What this is trying to say is that you can't just say, let's look at a transaction between independent enterprises and a transaction between connected enterprises and impose one on the other without doing an awful lot of underlying work to make sure that there really is comparability between the transactions being undertaken. And often commercial sensitivity means that it's quite difficult to actually find out whether those transactions are comparable. And that is one of the issues that we do see. When we are talking about comparability, there needs to be quite close examination of contractual terms. Obviously, contracts will determine division of responsibility, risks, and so on. you'd start off with the written contract, but most jurisdictions will also then want to look at all of the communications between the parties. And obviously then there is a need to examine the actual relationship to see if there is anything which is inconsistent with a written contract. So in terms of looking at comparability, then you have got a lot of work to do in terms of the contractual terms. And we'll touch on this with one of the examples that we look at later on. When we're looking at the contractual relationships, what there will need to be is a functional analysis. Who undertakes what in completion of the contract, who takes responsibility, provides assets and takes the risks. So a good example of who might take the risk would be, say that you are shipping assets halfway around the world. Who takes the risk in relation to that asset not being delivered? So let's just say you are shipping something halfway around the world. What happens if something happens to that shipment? Obviously very many circumstances, but if that shipment does not reach its end point, who is taking responsibility for that? Does the purchaser still have to pay for that? Does the supplier agree that if there is no delivery, then there is no payment? Obviously, that would be a key risk that would need to be identified. And that's one which is very obvious, but there may well be other risks that need to be taken. And so, again, we've got to look at that in both controlled and independent scenarios. And again, it's the commercial sensitivity necessarily looking at the differences between the kind of transactions that you might be looking at. Obviously, you need to have a good understanding of the characteristics of the property or services that are being provided. Are we talking about tangibles or intangibles? Are we talking about assets or services? Are we talking about licensing or sales? We're looking at the duration of the transaction, and we are looking at the anticipated benefits. And all of those different things are going to be very different in terms of how we might negotiate a transfer price. And obviously we've got to compare the markets being served and the economic circumstances of the transaction. We've got to look at things like availability of competition, substitutes, what the supply and demand situation is, what the consumer purchasing power is. Are there government regulations? Are there problems involved in marketing the asset? What is the location of the market? Is it a long way away? Is it close? What is the size of the market? Are there any particular costs, duties, taxes, so on, in terms of the actual asset that is being sold? And this all comes down to comparability. It's all about looking at whether or not we can achieve an arm's length price easily. There's no point finding an independent transaction which is serving a very different market and try and impose that on a different set of circumstances. Obviously, we are then looking at business strategies, whether there are any anomalies. How innovative is the company? How risk averse are they? Are they trying to diversify? Market penetration is an interesting one, because a company might decide that they are going to sell at a lower price because they are trying to achieve market penetration. Now, obviously, that would lower the arm's length price. Most jurisdictions will allow a lower price to be justified because of market penetration schemes, but only for a relatively short period of time, because they would probably argue that from a business perspective, you would not actually sustain a lower price for a long period of time. So you're not going to sell into a market over a very long period of time at a lower cost. Obviously, the extent of the time that you might sell at a lower cost will again go back to the nature of the asset, the nature of the market. Are there any particular anomalies in relation to the market? Just one or two other things to note. The OECD guidance is very particular about the fact that tax administrations should only be disregarding the transactions and trying to impose a different value in exceptional circumstances. So there is no support generally within the OECD and the international tax community for trying to make changes to a price of a transaction where the amounts involved are small. They will certainly look at large figures, but the basic premise is still that transactions will be treated as being arm's length unless there are exceptional circumstances. Just because a company is loss-making does not mean to say that there is a problem and that they are underselling their services, products, whatever. But obviously recurring costs, recurring losses, over a long period of time might be an indicator that there is a problem in relation to transfer pricing, which needs to be addressed. Existence of a particular workforce must be taken into account. So if you have a uniquely qualified workforce, if you have people who have skills which are very particular to a company or to a region or to a country, that must be taken into account. It is one of the factors, as well as the external factors, which needs to be considered in terms of determining what an arm's length price might be. And group synergies have to be assessed. Obviously, one of the main issues when you have large groups of companies is that there is cost saving by virtue of the fact that they have group synergies. So doing something for a large group of people will be cheaper than each of those doing it individually. And one of the basic premises of transfer pricing is that no value needs to be attributed in calculating an arm's length price for the benefits that are achieved by being part of a larger entity. So you don't have to say, well, okay, this is the cost. This cost, excuse me, would be greater if you're a standalone company, and that is therefore our starting point. So group synergies can be taken into account. Okay, so let's move on and just talk about the actual transfer pricing methods. There are 5 recognised methods. Many of them are similar. We will see similarities as we go through. We have what is called traditional transactional methods, and those are comparable uncontrolled price, resale minus or cost plus. We then have transactional profit methods, the transactional net margin or profit split methods. Probably the transactional methods, the top 3, are the ones that are seen as more robust. But as we will see as we go through, they are also not necessarily easy to achieve. So the comparable uncontrolled price, or CUP, is the simplest method, which effectively compares the price of a controlled transaction with a comparable uncontrolled transaction and looks at the difference. As we have already highlighted, you need to make sure that there is no material differences between compared transactions. It is the preferred method, but it is all about judging comparability. And all of those things that we've already talked about market conditions, risk, all of those things, functional analysis, contractual conditions, all of those things in complex transactions will often mean that it is impossible to be comfortable that there is a comparable uncontrolled price out there. And this example, apologies for it being slightly long-winded, but gives a very good analysis of those differences. So you've got a company that sells insulated jackets. So it sells them into lots of different markets. In Mauritania, mild climate, people don't really need insulated jackets. So anybody who is acquiring those assets as a distributor has to incur enormous marketing expenditure in order to encourage people to buy the jackets. In Z, the climate's freezing all year round, as soon as anybody gets stock of these jackets, they are sold quickly. They don't actually need to do any marketing at all. The first distributor, just on a very basic premise, will have a lower margin than the second because they are incurring the marketing costs. And so there is a difference between the transactions when the manufacturer sells to each party. And so when we look at what might be the arm's length price that the manufacturer might charge, well, the raw retaining distributor might, if he was independent, negotiate a lower price to subsidise his marketing costs. Or it might well be that the manufacturer will say, no, do you know what, I'm selling at a certain price, you have to live with lower profits. So you could have various different scenarios. That goes back to the point that we were making earlier on about risk. Who takes the risk of the fact that there are marketing costs in order to shift this product? Obviously, differences between the market might affect the price, but the manufacturer might say it is not going to affect the price, and it is the end distributor who has to take the risk in relation to the product. So that's a very good example of a situation where it is impossible to determine whether or not you have got the same or a different price in terms of comparability. Let's just look at the two effective methods of calculating comparable uncontrolled price. So here we have a situation where a company manufactures a product. It is a unique product, and that is relevant in terms of this calculation. There is a competing manufacturer who does produce a similar product, not identical, but similar. And so effectively we are looking at X being the manufacturing company of the initial product, supplying an order of distribution from another company with which they are connected. So that is the basic premise. They are looking at the transfer pricing issues. Now, there are two methods here. You have what is called the internal cup, and that is where you would look at the price which X sells its product to a third party. Or you have an external cup, which is where you look at the price at which a third party, i.e. the other vendor, sells their product to a third party distributor. And that is the external cup. Now, from an absolute perspective, an external controlled, comparable uncontrolled price is seen as better than an internal one. But obviously, if you are relying, and the reason an external one is seen as better than an internal one is that effectively you have a third party selling to a third party distributor. So you have somebody else setting a price for a similar product that they are selling to a third party. Obviously, in terms of whether or not an external or an internal cup would be appropriate would depend on how similar the products are, and also indeed whether or not X actually has any third-party distributors. If X is only selling to people with which they are connected, then you would then be forced to look at external cups, and in fact then you are basically just focusing on finding someone within the market who has a product which is similar to yours, both in terms of the actual product and the maturity of the market, and that is obviously where you have real difficulties arising. That's the straightforward one, and even though that is the straightforward one, we can see that that is in itself very problematic. And in reality, it is actually quite rare to find that transfer pricing disputes are settled using this method because of the real difficulties in establishing exactly how the parameters lie. The second one is resale minus, and this is typically where you have got purchase of goods for distribution. We've just seen that actually, purchase of goods for distribution, or where you have a distributor buying a product for sale from a manufacturing company. So basically what we take there is what the distributor is going to sell it for to the market, so you know what the independent sales price is, and then you reduce it by an appropriate gross margin. You would take into account any specific costs which are going to be incurred in making the sale. So if the distributor has marketing costs or anything similar, advertising and similar, then you can deduct those costs. You also then deduct what you consider to be an appropriate profit margin. Again, the issue here is calculating both what is a reasonable cost base in terms of making the sale, and also what the appropriate profit margin is. And again, what you might look to in terms of the profit margin in the costs is what similar enterprises in a similar market might well be creating, and that in itself is not straightforward. So we have a company here which sells an exclusive non-alcoholic beverage. Its market price is £10. The company does not sell that beverage to any independent distributors, so there is no third-party arm's length price. There is no comparable beverage in the market. However, they do identify a competing beverage, which is an alcoholic one. Its market price is also £2. The distributors report a profit of £2 per bottle. They have to pay duty of £2 per bottle. There is no internal or external cup. And so what you might do in this situation, say that actually the distributors are comparable, that the gross margin and the customs duty can be used to get a resale minus price. That would give you a transfer price of £6 on the basis that you have got direct costs of £2, profit of £2, and that gives you a reasonable arm's length price. Obviously, you have to be very careful about that, because the obvious discrepancy in this particular example is the fact that the other product is an alcoholic beverage. It might well be that customs duty would be very different from an alcoholic or a non-alcoholic beverage, and also the profit margin might be very different. Certainly within the UK market, the profit margin on non-alcoholic drinks in pubs, supermarkets and so on is vastly in excess of that which would apply for a non-alcoholic product. And so actually that is quite a good example of a situation where you might identify what you consider to be a comparable product, but actually it's not. That having been said, what we are looking for is not a comparable price. What we are looking at is an idea of what the sales costs and the gross margin might be, and therefore the differences between the transaction may well be capable of slightly more straightforward analysis. The other mechanism is cost plus, and cost plus is typically used where there is no end market. So where, for example, you are transacting in semi-finished goods. So there is no third party, there is no consumer who is going to be acquiring those goods. So you simply take the costs in making the supply and apply a percentage which is seen as an appropriate profit margin. This is the method that is often used for provision of intergroup services. And again, the appropriate profit margin should be calculated by reference to a comparable uncontrolled transaction, which can itself be quite difficult, and in fact in my experience is often quite a random calculation. If we're talking about something like intergroup services, most people will either apply 5% or 10% because it is considered to be around about the right figure. So here we have a company providing administrative services into the group. They're looking for a profit margin, and again, when you're looking at profit margin, there are two methods. There is the internal cost plus method, where you look at company X, what they would charge to a third party. Quite often there is no third party, so that isn't possible. External cost plus would be looking at what an independent enterprise would charge to a third party. And again, that's often the one that will be used in this scenario. If we get onto the transactional methods, these are very, very problematic because of the, we are looking at sort of the overall transactions involved rather than necessarily looking at the overall profitability. Again, when we're looking at the transactional net margin, we are again looking at net cost plus or net resale minus. So if we were looking at something like net cost plus using the transactional net method, we would take the total costs of providing the services, and then we would effectively add a margin to that. So here, what we do is we say, sorry, the costs are £125,000. We find a third party that appears to have costs of 400,000 and profits of 100,000, which means that the net cost plus margin is 0.25. We apply that 0.25 to the 125,000 costs, and we end up with a transfer price of 156,250. Resale minus works on the same basis, except what you do is you're looking at the ratio of profit to sales rather than profit to costs. And again, we work it out looking at all of the resale price of the items that are being sold. It's quite rare to find this method being utilised because it is very similar to the other ones that we've already looked at. What we see more often, even though it is often described as the method of last resort, is something called profit split. So you take the starting point and the ending point, you look at the total profits being achieved by the organisation, and then you basically split it between the different parties. There is really, to be perfectly honest, no foolproof method of working out the split, and it is often down to negotiation between the parties. Okay, so the time is now 1 o'clock. That is the end of the formal part of the presentation. If you do have any questions, please feel free to pop them onto the screen now, and I will deal with them if they come in. But otherwise, thank you for your time, and I hope that you have enjoyed this webinar.